What happens to your assets when you die? Well, if you have a spouse, that's good news. It means you can elect to have a tax-free rollover from your assets to your spouse. But if you don't have a spouse, or if the second spouse passes away and you're looking to pass your assets down to your children, that's when a tax bill can occur. And the reason this tax bill can occur is because the moment someone passes away, it's as if they've sold everything they've ever owned. It's called a deemed disposition. So even though technically you haven't sold everything you've ever owned, the CRA treats that like you have. So depending on the assets you have, if there's been growth, there certainly can be a tax bill associated with passing those assets down to your children. Let's take a look at some of the assets someone could own where there could be a hidden tax bill within them. So what happens at death? Let's take a look at someone who has a rental property, a family cottage, assets in their corporation or holding company such as retained earnings. They have an RSP, maybe it'll convert to a RIF by the time they're 71. They have a non-registered stock portfolio, and last but certainly not least, they have Bitcoin, Ethereum, and they have a crypto portfolio. If the value of these assets are higher than when this person either bought the properties or invested in these stocks in crypto, there's going to be a capital gain. And like I said, the moment someone passes away, it's as if they've sold everything they've ever owned. So the value of all these assets, if there's been growth from the time the person originally obtained them to the moment they've passed away, the value of these assets instantly decrease the moment this person dies. And that's because of the taxes. So when someone calculates their net worth, they typically go assets minus liabilities equals net worth. But I always suggest taking it one step farther to calculate your estate worth. And your estate worth is your assets minus your liabilities minus the taxes owed in your estate. And that's what these red arrows represent, are the hidden tax bills amongst all these assets the moment someone passes away. Now, to look at one more asset, and this would be life insurance, whether it's a tax-exempt whole life insurance policy, universal life, or even term. This is pretty much the only asset that goes the other way on death. It actually increases in value when someone dies. Whatever you've put in, you're going to get a multiple of that in tax-free payment from the life insurance company. So that really shows the power of what an insurance policy can do, because that green arrow pointing up can hopefully replace all of those red arrows pointing down. So your estate isn't left with a massive tax bill that has been unaddressed, and now you have to fire sale some of the assets in your estate or take loans or remortgage or something pretty ugly. So looking at your assets, make sure you don't just calculate your net worth. You should calculate your estate worth and then look at some strategies to replace or pay for these taxes in the most cost-effective manner. Thanks for watching.